trust in traditional state institutions erodes. So smart capital is hedging against the very system that they are part of, and industrial grade bot farms. You have coordinated pump schemes. There's also coordinated and shady market making even. USDT and USDC are not censorship resistant, just to reiterate it once more. At any time, Tether as a minting company and Circle can freeze balances.
Bitcoin is an operating proof that money is being redesigned by code, by perception, and by policy. Today's guest is Igor Hadziahmetovic, investment director and Web3 tech lead at Venionaire Capital. He builds a thesis around crypto trends, connects the dots across capital markets, and isn't afraid to call out what's real and what's just noise. From VC strategy to macro narratives, stablecoin wars to Bitcoin on corporate balance sheets, and much, much more. We're diving deep into the next stage of digital assets. Igor, thank you for coming today.
Happy to be here, Nasib. Thank you for inviting me.
You've definitely had an interesting journey and path into crypto. What first
Yeah.
got you into the space, and how did that turn into what you're doing now at Venionaire?
Um, I would say curiosity back in mid 2017 when I started it all. Um, it was about how modern money works. If I put my 100 euro bill into my bank account, it shows up in my bank account balance. And if I send that money to my friend across country or in another country, I was always, it was unclear to me how is it that this physical bill does not change place physically, geographically, but I'd still get to transfer that money and it's gone from my bank account. So this curiosity led me to learn about Bitcoin, to find out what Bitcoin is as a peer-to-peer e-cash payment system. And this opened up a world to and open up a new world for me, with a lot of people, ideas, projects that were working or that are still working on open and free financial systems. This crypto ecosystem that suddenly opened up in front of my eyes was actually an innovation hub, very, very vibrant and energy driven, innovation driven, maybe a crypto nation, an isolated island that opened up a lot of investment opportunities as well, because all those innovators and disruptors with new technology, with new ideas, were looking for capital. And my technical and business background and understanding helped me to make a good distinction or to filter out better investment opportunities, which of course helped a lot where I should put my money in. And I think over time, my experience when it comes to technical research and fundamental research and analysis around the projects and around this ecosystem allowed me to support Venionaire Capital today when it comes to investment strategies, investment decisions in the crypto landscape focused on the blockchain and Web3 projects.
Mhm. Your background blends technical knowledge and capital strategy. How do you see and how do you use that combination when you are making decisions around early stage projects or tokens?
I evaluate projects across a couple of different dimensions. For me, very important: real utility, revenue, sustainability, technical maturity or technical stack, technical dependencies with other systems, how stable or secure the entire construct is, um, developer activity and user behavior or patterns in user-based behavior is also something to look at. For example, governance quality and the level of decentralization. Is there, let's say, governance capture, where only a handful of people control the entire protocol destiny, so to speak? Of course, token utility at the end of the day is very important. One additional aspect that's changed over the last 12 months is the aspect around regulatory alignment, regulatory compliance of said projects. So to put it all together, it helps to identify protocols and projects that combine technical innovation with sound business fundamentals, because it is very important for said projects in order to be able to survive in the long term. At Venionaire, we are actually more interested, or we are looking for supporting the next Azure or AWS of Web3, instead of chasing the current shiny thing, what's in the spotlight. So in this sense, it is a marathon. It is not a sprint. So you need a lot of patience and a lot of focus to put it all together.
What's your current lens as an investor in this market?
Okay, crypto markets are increasingly becoming an integral part of the traditional finance infrastructure in general. So you have now stablecoin regulation that is actually allowing a direct integration into traditional banking and payment systems. And stablecoins, as such, connect on-chain and off-chain economies. Um, you have also structured regulatory support, which we are seeing for companies and investors of all sizes and calibers, which is in a way going to connect different industries and economies worldwide in a way that we have it already with many AI tools. So the user will not be actually be aware what's going on the back end, but will be able to use much better services and products. So I think that we are not any longer in an experimental phase. We are transitioning to the institutional adoption phase. And I would say that this requires a bit different investment approach. So my lens would be, institutional and retail utility of projects, regulatory alignment, regulatory compliance, sustainable business models and practices, of course, including tokenomics. So that means that now I pay more attention to macro and political regulatory developments and conditions, because you have to stay aware what's going on. And I think that it is good to have made this shift towards projects that stand to benefit from regulatory support, regulatory, let's say, enablement, or institutional infrastructure in general, um, because this regulatory clarity and institutional adoption, for example, from larger investors, is going to create a positive feedback loop for said project. Um, Another thing maybe is to mention that I focus on revenue generating projects much more than I used to in the back in the last 2 years, for example, that have real economic utility and sustainable tokenomics. So I don't invest as much purely in technical innovations without a sound business model that accompanies it. And this is the new lens I apply.
How do you stay clear headed when narrative cycles move faster than fundamentals?
Uh, that's a good question. I stick to fundamentals and let narratives just pass by. There is big information asymmetry in markets in general, and especially in crypto markets, being such a young industry and all. And crypto narratives tend to be short-lived. They are per design, just focused on extracting maximal value very shortly or shortly post project launch, token generation event, for example. So I stick to my mid and long term strategy. I resist chasing the next shiny thing that is actually that is currently in the spotlight, and combined with the rules of my fund's mandate, it actually creates a form of protection, let's say guardrails, because my priority is to protect my LP's capital, through sound risk management, clear entry and exit strategies. And you have to have flexible and disciplined positioning, meaning when the circumstances change, I adapt. It is when facts change, I adapt. So that's you have to have a certain goal and plan, but you have to also maintain a certain flexibility to adapt when circumstances change. So I mean, there's always another opportunity, another narrative, another meta, how they call it. Uh, I would say what's scarce is the fundamental quality that has, sustainability as its core component. That the project or the idea survives in the long term. I mean, because the crypto narratives move so fast, move let's say on a weekly basis, or change on a weekly basis. Fundamentals are actually something that plays out over the years. So that's why I focus on it.
When a project looks great on surface, what helps you figure out if it's real or just well marketed?
As mentioned earlier, there is maturation in this in the investment approach in this industry in the crypto landscape. You're moving away from speculative spray and pray tactics, how they call, towards fewer high quality investments that are based on strong fundamentals. Fundamentals depend on what kind of project it is, what does it do, who else is doing it already. So you have to figure out what is the relative value basis for the project that you are, let's say, looking into, or an investment. And sometimes it can be a simple comparison among peers, from the same basket or same category of project. And sometimes it is the relative value basis against BTC or Ether or Sol. So you have to be mindful of those things. I mean, this shift in investment approach has a lot to do with the changes in the regulatory landscape that we are witnessing right now. Where VCs and private equity and investors, serious investors, focus more or apply more those traditional due diligence frameworks. So you'll take a look at stuff like operational history, stability, revenue generation, what kind of revenue streams are there, how sustainable they are, what about user retention and general operational costs. Depending on the project, of course, you have to take a look at the levels of decentralizations, maybe nodes distribution, security, security audits. There's a lot of moving parts. Another aspect to look at is, for example, interoperability of the underlying protocol, governance mechanism. Is there a history of governance approvals that actually improved the protocol, or is it just like voting for the sake of voting? Um, Meaning governance structure is very important depending on what kind of projects we are looking into. Um, since this regulatory landscape changed, you also look at stuff like institutional partnerships, the team structure. Is the team doxed? Is the team still anonymous? Who are you dealing with? What kind of track record do these people have? And ideally, the project would also have some form of regulatory alignment, because this is increasingly an aspect that adds value to the project itself.
There's been a lot of talk about Bitcoin separating from traditional markets.
Yeah.
From your perspective, is that actually happening?
Um, yes, actually it is, but I would say it is nuanced. Bitcoin has evolved from being, primarily a risk asset, like more correlated to tech equities as an emerging technology, for example, which are usually very volatile. And it evolved to developing some properties of both risk assets and store of value over different market cycles that we've had over the last 15 years. So I like to call it like duality of Bitcoin or double identity of Bitcoin. This separation is, I would say, happening gradually, and is driven by regulatory clarity that has increased tenfold over the last 8 months or so, and on the other hand side, institutional and corporate adoption. So there is a clear perception shift when it comes to Bitcoin and its role in strategic reserves, corporate treasury, traditional portfolio management. Um, because today Bitcoin is an asset class of its own, so it's a league of its own. It's not really directly comparable to anything else out there. So it is positioned as an alternative global asset, which is free of capital controls and free of currency devaluation risks, I would say. So, since start of the year, this year, 2025, Bitcoin demonstrated remarkable resilience. We had, a lot of market turmoil across all asset classes, and a lot of headwinds, including, surging bond yields, especially in the United States, tariffs escalation, national debt situation in the United States, Fed policy, monetary policy, fighting inflation, and also kinetic and economic wars over the past 7, 8 months, like really nonstop. Something that disturbs the stability of markets across all asset classes. And Bitcoin really showed remarkable resilience. So I think that we are in early days of institutionalization of Bitcoin, um, with vast amounts of capital yet to come, yet to start flowing in.
What should investors be looking at when comparing BTC to gold or equities right now?
I'd look at a couple of things actually. The relative performance of Bitcoin against gold. This can give you insights into relative strength and strength development between the two assets over a period of time. You can also see if there are periods where there is positive or negative correlation. Um, how is Bitcoin performing relative to gold? Is it rising? If it's rising, then it's performing better than gold, which will also lead to better performance in USD terms, meaning BTC or USD price is surging. Why is it surging? You can observe such relations and draw interesting conclusions. um, I'd also look at gold BTC ratio versus BTC equities, or specifically S&P 500 ratio, because in a similar way you can observe the spread over time and between the two, and draw also interesting conclusions. Um, it shows how gold performs against Bitcoin compared to BTC performance against US equities. This is, I would say, something that many young investors do not pay attention to. Bitcoin observing these ratios clearly shows that Bitcoin outperformed both gold and U.S. equities over when you look at past 2 or 3 years. And you can draw the conclusion that yes, gold maintain its value, but Bitcoin, it cannot match the Bitcoin's outperformance against U.S. equities. For an investor, this can mean, this can help decision making. Should I invest in equities or in gold or in Bitcoin, and during which market conditions is it meaningful to rebalance the portfolio in this way? Another thing I'd pay attention to is Bitcoin's return on investment and CAGR, or compound annual growth rate, um, against gold and US equities, or S&P 500 specifically. Statistically, over the past 14 years, Bitcoin outperformed both in every single year.
Mhm.
So this is remarkable.
Does Bitcoin still behave like a risk asset, or are we watching it take on a more defensive role?
In its earlier cycles, Bitcoin behaved as a high risk, high performance asset, similar to emerging tech stocks. which means high volatility, high return, but also high losses, potential losses, and deep retracements. I think that these characteristics are on the decline, meaning there is less and less volatility, which was also possible. Which was also possible to observe during the first quarter of this year, where compared to equities, our Nasdaq, Bitcoin showed much lower volatility. Especially when you compare Bitcoin's current volatility to its historical volatility. What's on the rise now, I would say, is that Bitcoin is acting more like a hedge asset, a gold-like hedge against political and economic instability. Yeah, a digital store of value, which is resistant to capital controls and to censorship. As mentioned earlier, Bitcoin is a global alternative asset, and this is just to reiterate again earlier mentioned duality of Bitcoin, where it has characteristics of both risk-on asset and store of value in a digital form.
People still associate Bitcoin with heavy volatility, but
Mm.
over multi-year periods, the performance is hard to ignore.
Yeah,
That's for sure. How do you make sense of that for portfolio construction?
I mean, all crypto assets in general have very high volatility. It's just how the crypto landscape and markets work. But not all of them have same risk profile, and you have to take that into account when constructing a portfolio. When you, for example, also rebalance your portfolio, you have to pay attention to those risk profiles. And risk profiles with altcoins, especially, change very quickly. So since 2017, the number of altcoins, meaning everything besides Bitcoin, was between 800 and 1,000. And today we have literally dozens of millions, meaning coins and tokens combined. And we have hundreds of blockchains alone. Many of them are EVM compatible, or meaning virtual machine compatible. So you can run smart contracts on top of it and launch like thousands of tokens. Um, but since all of those that were around back in 2017, only a handful of them actually outperformed Bitcoin over the same period of time, and 99.99% disappeared.
Mhm.
And this is a point a lot of people or investors that are entering crypto now uh, tend to overlook, this graveyard of altcoins that disappeared very quickly. So for a multi-year investment, buy and hold strategy for Bitcoin or for Bitcoin accumulation has proven statistically to be very hard to beat.
Has the digital gold narrative become a practical thesis now, or is it still just rhetoric for most allocators?
I'd argue that for sophisticated allocators, Bitcoin as digital gold has long become practical thesis. Now even more so with regulatory support that we have in place. In addition, we have institutional infrastructure in place, um, readily available, and Bitcoin's proven resilience over the past 15 years, as I mentioned earlier. So for others, it's still evolving from rhetoric to reality, but for sophisticated allocators that been around for some time, this is long become practical thesis. You could also say that maybe we're in a transition phase now, moving from digital gold narrative to institutional behavior, on the back of this regulatory clarity and current market developments that we have. So again, the infrastructure is there, and I think the question is maybe adoption speed, fast movers versus laggards, and the risk of being priced out.
There is a growing sense that traditional financial and political institutions are losing trust globally.
Mm.
What does that mean for how Bitcoin is being perceived?
Um, I think that Bitcoin is directly benefiting from this erosion of institutional trust. What we saw since the start of this year, especially in the United States, with US government bonds, which are traditionally a safe haven, um, they were actually failing in that role. So US government bond yield skyrocketed across tenors, especially long end like 20 or 30 years. Uh, Trading repeatedly over 5%, which is super high for bond yields. So in the eyes of creditors, this is a sign of a diminishing trust in the credibility and stability, reliability of the United States government to pay back their debt. Hence the demand hence the demand with higher yields to take on the risk of lending money again to the United States government. So U.S. national debt surpassed 37 trillion. Like that's a giant number, 37,000 billion US dollars. So, and the administration needs new debt to continue servicing the existing debt, to continue servicing the interest payments. So, uh, we also saw that US dollar index or Dixie plummeted over 12% since the start of the year. So, all this is relevant because US dollar is the world's reserve currency, and this has major impact on financial services, financial products, and the world trade in general because world reserve currency, almost everything is priced in US dollars. So this has also relevance to ongoing devaluation of US dollar. So it's maybe a paradox or irony that while trust in traditional state institutions erodes, at the same time you have Bitcoin gaining institutional legitimacy through regulatory clarity and support. So smart capital is hedging against the very system that they are part of, and in a way, Bitcoin as an alternative global asset is used as institutional hedge against state institutional failure.
Is this erosion of credibility actually showing up in BTC flows or positioning?
Absolutely, I would say absolutely. I mean, the capital flows are showing a clear pattern of accumulation also during market stress, as we saw in the first half of the year, where Bitcoin show the remarkable resilience against other asset classes. This is true for both Bitcoin and gold. The accumulation flows. You have strategic reserves, you have corporate treasuries, you have sovereign funds and spot ETFs that have all together fundamentally reshaped the structure of Bitcoin demand. So since start of the year, just to give an example, U.S. spot ETFs have had 19 billion of net inflows, and Saylor alone with his strategy company has contributed around 15 billion. Just these two actors, let's say, when it comes to flows in Bitcoin accumulation.
We have seen more companies add Bitcoin to their balance sheets. Do you think this trend has legs or is it still mostly symbolic?
I think this is the new norm. This trend has clear, strong momentum, and it's moving into mainstream corporate strategy because it offers alternatives to traditional cash management system. If there's a market turmoil, some sort of crisis, you tend to increase your cash quota and wait until the situation until the dust settles, how they say it. Companies are now moving from should we to how much. However, I would say the number of companies that will be able to afford exposure specifically to Bitcoin will rapidly decrease. Sailor's model is being for other crypto assets as well. Everybody is trying to jump on the bandwagon right now. So we'll have a growing offering of other viable alternatives to Bitcoin on your balance sheet or as a part of your corporate strategy. Albeit these other alternative assets will have, of course, lower value and security compared to Bitcoin. So this might create second-order citizens. Currently there are over 70 upcoming spot and futures ETFs in the pipeline, and this is, in my view, institutional response to a real demand and not just speculation. I think BTC on balance sheet. I think BTC and balance sheet could have a positive impact on a corporate and private credit if the involved parties, creditor, and debtor agree on Bitcoin as collateral, which, in my view, shouldn't be a problem as as 5 or 10 years ago. So sovereign debt issuance, for example, U.S. Treasuries or German Bund. In my view, are unlikely to use Bitcoin or any other crypto assets for this particular purpose or for this matter. But companies already can, and with increased regulatory backing, there is no reason not why not to do it. So one point I would like to add is that small and medium enterprises will increasingly get priced out. um, the little guys like sole and micro entrepreneurs and small companies, even more so. They will really get really heavily priced out. And ironically, Bitcoin was meant for the little guy, not so much for corporations and governments. And of course, yes, you can argue Bitcoin is meant for everybody, but I'm just trying to paint a picture that a lot of smaller guys are actually going to be left behind.
Mhm. What needs to change before governments or sovereign wealth funds start holding Bitcoin seriously?
Hmm. Um, I would say mainly the political will. Structured regulatory support that we have now and coordination in this matter are nice, but they are still insufficient. There are still bottlenecks. The infrastructure, as I've mentioned, is already in place. So, data clearly shows governments, worldwide governments and sovereign wealth funds accumulating Bitcoin, essentially competing with corporations like Sailor and the likes. So maybe there were also some other points to mention that I see in need of change. You have something called political risk or political comfort. For example, Bitcoin will not become political liability, and this ties into this political will. Another point is you have to have new accounting and reporting standards that are appropriate and applicable for this unique new asset class that Bitcoin actually is. Um, in this regard, custody solutions are also another point because you have let's say state security requirements, which are a bit, I would say, a bit different than custodial solutions for retail investors or retail clients. So it's a whole another level of security, and this type of custodial solutions also needs to be in place. And the last point would be domestic and international coordination, meaning, for example, you have to have alignment between central banks, commercial banks, which are part of the financial and payment system, and you have to have alignment with foreign policies because every sovereign nation, sovereign economy has to have certain coordination with others when it comes to Bitcoin. So I think that some countries will move faster than others, but at the moment, I think we are on the right track to gain stronger political will and commitment because political perception has also shifted around Bitcoin.
There is a sense in your research that the altcoin market has become increasingly distorted. What do you see happening behind the scenes that people might not be aware of?
Well, what many might perceive as organic market activity for the majority of altcoins is largely engineered, meaning engineered trading volumes with low liquidity. You have industrial grade bot farms, you have coordinated pump schemes. There's also coordinated and shady market making, even. You have fee based, very strong fee based incentives for centralized exchanges to list and promote any garbage tokens out there without um, um, it's not an overstatement. That's what I'm trying to say. So big money is paid for influencer and KOL campaigns, key opinion leaders, which are disguised as organic enthusiasm endorsement of the project, which is of course not the case. So a lot of deception, a lot of outright lying, and smart money has shifted toward quality, utility, solid business models in the sense, in the context of sustainability and longevity of the project. So the focus moved towards Bitcoin and some battle-tested larger projects that have been around for quite some time, so-called blue chips or altcoin majors, um, and this divide between real projects with utility versus sophisticated marketing fake projects has always been part of crypto landscape, but this separation grows stronger by the day, I would say.
Has the structure of token launches made long term investing in altcoins effectively unworkable?
Well, that's a good question. Yes, I think so. Um, Unfortunately, that's the current state of things. Largely the so-called spot and chill investment models have proven to be broken. They've been systematically undermined by faulty launch mechanics. You have massive scheduled token emissions. You just hit the market, flood the markets, and dilute every holder out there. So the token inflation is usually static in the sense that it does not care about any changes in the demand side, which means it is not adaptive. You just have protocols just print into circulation as programmed without any consideration of is there any changes in the user base growth. So supply eventually, overpowers demand, which drives the price per unit down. This is not the case, of course, with all of the projects. I have to mention that, just to be clear. But adding to this mix, you have also insider games. Early distribution allocation to insiders and team that end up holding the majority of token circulation. Um, which often leads to long-term holders or investors who enter over secondary markets to be at a major disadvantage, of course. So, combined with engineered market activity, as mentioned earlier, spot and chill investors often get um, they often cannot distinguish between real and fake growth until it's too late. So again, not all protocols are created equally, of course. Token launches are, I would say, largely optimized for quick liquidity extraction. I think I mentioned that as one as well, because soon as the project launches, sometimes within 1 or 2 weeks, the entire price, let's say, just collapses. Of course, there's difference between price and value of underlying asset, but these token launches are seldomly optimized for any long-term value creation. So you can also say Bitcoin's model HODL is equal to this spot and chill, which is not really the case. It is, I would say, fundamentally different ball game.
Mhm. If only a handful of altcoins outperformed Bitcoin after the last major downturn, what does that say about the broader space?
Well, it says a couple of things. I think the performance gap is very wide, and this stems from crypto landscape splitting into fundamentally, I would say, two tracks. You have Bitcoin as digital gold, an asset class of its own, and you have everything else as blockchain technology. So both can succeed independent of the other. I think Ryan Watkins from Syncrasy Capital said once. I'm paraphrasing: Bitcoin as digital gold is fundamentally different than a DeFi token that resembles equity, which is true. So I think that the markets now are pricing this distinction correctly, which shows, of course, in this performance gap. There is also institutional recognition and the fact that Bitcoin benefits from different demand sources, as we've already discussed. So, of importance is to note this existing infrastructure advantage that Bitcoin has, ETFs and regulatory use case legitimacy, everything that the majority of altcoins do not have. So it's not really comparable. And I would say also that we are seeing market maturation in a way. The speculation premium has largely evaporated, and this speculative phase, I would say, is ending. The infrastructure phase is beginning, I would say. So I think that most projects and protocols will not survive this transition.
Now, for long term strategies,
Mm.
is Bitcoin still the most rational base layer for a portfolio?
Good question. um, well, I would say yes and no. It depends on your time horizon, your risk appetite, overall investment strategy, what areas or subcategories of digital assets landscape are you focused on? What do you want to do? Where is your edge, so to speaking, in which areas? So I'd say that Bitcoin has evolved into a rational foundation for any serious 1 to 3 years allocation, which, in my opinion, for crypto industry is a long-term period. Uh, as mentioned before, Bitcoin continuously outperformed both gold and S&P 500 or US equities in terms of CAGR and return of investment. In the turbulent 2025 market, as we've seen over the past 6 7 months, I mean, Bitcoin's pullbacks have been less dramatic and its recovery much faster. So, compared to altcoins, definitely. So together with Bitcoin's lower volatility, this gives the resilience you want to have in your base layer position. Also, Bitcoin's duality or dual identity, as a risk hedge and as a risk on asset and a hedge asset, this also gives you certain optionality that altcoins do not provide. Same as with legitimate institutional access. You have that for Bitcoin, and for the majority of altcoins, something like that is just non-existent. So I think that in long-term portfolios, Bitcoin is not just rational, I would say it is perhaps essential.
Do you think that the current wave of speculative token design can offer meaningful upside without unacceptable risk?
For most current token designs, I'd say no. The risk reward is structurally broken for investors. Speculation and gambling have their audience. There's an entire subcategory of protocols built just for that. But faulty tokenomics design can a very fundamentally sound project because the token or coin holders get crushed by too high inflation. Um, Admittedly, it is very difficult to align, the incentives of protocol stakeholders in a sustainable way. That is really not an easy task to do, and there is no single design blueprint that matches any protocol's purpose. Protocols are all built differently, and the thing is, due to smart contract nature, usually when you deploy certain tokenomic mechanics, generally it's immutable. You cannot change it. So it creates a very, very challenging task, which has no single solution that fits all purposes. Some good exemptions or let's say examples would be um, tokens that function like equity, that have maybe revenue sharing mechanism, that have adaptive or deflationary supply dynamics, have maybe solid utility. Ideally, to add to the mix to some very good decentralized governance model that has no governance capture issues. So those are some examples, and there are projects like that out there. Usually protocol design um, assumes maybe too optimistically or too carelessly that the future user demand is only going to grow. Everybody's going to love us. Everybody's want to have piece of our token coin project, a piece of our action, which is not the reality of things. And as long as the demand for tokens outpaces the inflation rate, I mean, you're all good to go, no problem. You have 15% inflation per week, not a problem. If you have 25, 20%, increasing, growing rate of demand to match that or to outpace that. When this changes, then you have a problem, which is often not necessarily death spiral in this sense of the terminology, but you have a very, very big issue. Um, Another consideration would be regulatory alignment, or at least avoiding some obvious pitfalls depending on your jurisdiction or target geographies for your project. For example, is your token a security? What kind of token is it? What kind of functionality does it have? And how is this in line with any maybe regulatory considerations you have to be aware of? So again, it's a very challenging task.
Stablecoins have become a huge part of the crypto stack, but you have framed them as geopolitical tools as much as financial ones. Why?
Well, because USD denominated stablecoins are effectively extending US monetary and regulatory reach globally through private companies that issue stablecoins. So this is a great addition to geopolitical strategy toolbox, I would say. Especially as stablecoin infrastructure becomes critical financial infrastructure, and foreign digital economies increasingly get access to USD stablecoins, or increasingly get integration into payment systems that support USD stablecoins. So when you mandate by law that USD pegged stablecoins must hold US treasuries or bonds as collateral, then you are actually forcing a demand for US debt. We've spoken earlier about the eroding trust and confidence of foreign investors. Sorry, investors in the US government, as is reflected in high bond yields for lending, especially 10 years and 30 years with over 5% at the moment. So US dollar position as world reserve currency gets undermined by the lack of demand for US dollars, which affects the US dollar strength and purchasing power. So at the time where, when US national debt surpassed 37 trillion, and their government needs new debt just to service the interest payments of existing debt, stablecoins, USD denominated stablecoins, create a new demand vector for USD and USD for USD dollar and for US debt instruments. So this will not, of course, solve the problem of US debt situation, but it can help because the US Treasury market liquidity actually directly benefits from collateral requirements for USD stable coins.
Mhm. Alright. With the US actively shaping stablecoin adoption through policy,
Mhm.
what are the second order effects globally?
USD stablecoin transaction volume in 2024 surpassed Visa and MasterCard combined, which is around 28 trillion US dollars. This shows real economic activity behind usage of USD stable coins. So it is an emergence, I would say, of a parallel financial system that is US dollar denominated but operates on a programmable public blockchain infrastructure. So in a way, it is, in my view, a supranational form of a CBDC, which is accessible in any country, but solely controlled by the United States government. USD stablecoin regulation will also allow direct integration with traditional banking systems, and the use of stablecoins is actually permitted for institutions to be used for treasury management. I mean, just this statement alone shows how big of a change and a big of role USD stablecoins have. So branded stablecoins is something that I think fintechs and retail companies like Amazon, Apple, Meta, Google will launch, and their versions of customized stablecoins will be easily integrated in their existing product ecosystems, which amplifies the demand for US dollar worldwide, and of course the reach of US government that has an influence on US companies who are issuing US denominated stablecoins. I mean, you have to mention, or you have to be aware of certain risks that are, in my opinion, humble opinion, real, very much real. You would have increased dependency and sensibility on US monetary policy, any regulatory changes, law changes, regulatory reach. You would have sensibility and exposure to control and censorship capacity from the US government, because a USDT by Tether, issued by Tether, and USDC issued by Circle are not censorship resistant. There are tokens that are not censorship resistant, which a lot of people unfortunately are not aware of. So change in USA regulation would impact, other economies, other businesses, other consumers worldwide. Uh, Starting from the lowest level possible, and this in real time. There will be no time delay. Any changes are implemented immediately around the world. So, think of consumer protection, maybe privacy laws, maybe credit scoring systems, both for individuals and businesses alike, that would be um, exposed to such, let's say, influence.
Can Europe push back meaningfully with Mika, or is the USD denominated stablecoin dominance already locked in?
Very good question. I think provides, Mika provides regulatory framework for euro stablecoin alternatives to US dollar stablecoins, but the US dollar stablecoin dominance has very strong network effects. Euro stablecoins would merely, to put it bluntly, would merely play catch up to an already established ecosystem of the past over the past 10 years. So it would not be as easy. You have European banks and corporations that can now, based on MiCA, have um, legal justification to have exposure to euro stable coins. It's okay, you can do it. Now, you don't have to worry. Um, but they often prefer USD exposure for international business, for doing international business, which, if compared to traditional banking system, you would have T plus 2 or T plus 4 business days until the settlement. And with USD denominated stablecoins, you have that instantly with much like incomparably lower costs. So, the global reserve currency advantage that the US dollar has compared to euro as a fiat currency also means that euro stable coin may remain more of a regional solution instead of a global alternative to US dollar or US dollar denominated stable coins. I mean, uh, MiCA gives the regulatory clarity, yes, but it does not solve the liquidity bootstrapping problems. Euro stablecoins need to directly compete with USD stablecoins and with companies who are minting USD stablecoins, which actually hold a lot of US treasuries as collateral. So in addition, you have very deep integration across all major blockchains for USD denominated stablecoins, and this is not since yesterday. It's like, as I've mentioned, over the past 10 years. So you have a vast ecosystem integration of USD stablecoins. For any maybe domestic on-chain and off-chain economic activity, euro stable coins could help reduce dependency on USD stable coins, but at the moment I don't see much of a demand for euro stable coins. um, I've never used them personally and don't see any major protocols that have any significant TVL or market cap in this sense. So USD maintains the global, let's say, liquidity advantage for global trade and for the crypto industry, which are now interwoven. Uh, and euro stable coins can work on achieving maybe less dependency, but certainly, in my opinion, certainly not the dominance.
The stablecoin market is growing fast and it's driving a huge chunk of on chain liquidity.
Yes.
Is that centralization something we should be all worried about?
Well, let me start with saying yes and no. I mean, fully collateralized stable coins are usually centralized. I mean, that's the feature. Over collateralized stable coins do not need a centralized minting entity. So, in general sense, first answer is no, because there are almost 300 different stable coins at the moment, including a handful of non USD denominated. Total market cap is 260 billion US dollars, out of which I think 62% is dominance held by Tether, issuing USDT, which is followed by Circle with 24%, something like that, 24.6%, and Circle is minting USDC. So maybe the answer is now yes, centralization is currently very high, with clear concentration of power in two privately held companies that dominate global stablecoin flows, which of course creates massive single point of failure. Um, I mean, USD stablecoins are the backbone of on-chain liquidity. That's just the fact. So they are the foundation of for DeFi in general, DeFi lending, trading, yield generation, you name it. If USDT and or USDC face any operational issues, the entire on-chain economy could freeze. realistically speaking. For example, any major regulation or any major regulatory action against those two companies could trigger depegging of their stablecoin and hence liquidation cascades across DeFi. I mean, this already happened a number of times with USDC, where USDC, significantly depegged around 20-25% several times, which triggered a lot of liquidation cascades in DeFi products, especially end of 2023. So speaking of freezing, USDT and USDC are not censorship resistant. Just to reiterate it once more, at any time, Tether as a minting company and Circle can freeze balances. They can blacklist addresses. They can force compliance with any sanctions in real time. Um, in my opinion, this is unprecedented control over any stablecoin flows globally, which is in the hands of only two privately held companies, which are under US regulatory influence. So there is an inherent risk of losing independence for global consumers and businesses.
Mhm. How does the stablecoin battleground between the fintechs, traditional banks, and crypto native players affect the way this infrastructure gets used?
Well, that's a multi-layered question, very interesting one. Let me start off by saying that stable coins are tokens, they're not coins. That's very critical distinction between the two. Tokens are arbitrarily programmable, uh, yet they are composable with DeFi and on-chain token economy. So they don't have to be, they can be. You have this arbitrarily programmable optionality, let's put it like that. And as such, stablecoin require an underlying settlement layer, which is layer one, um, that has robust smart contract capabilities or functionality. This enables different variations of, let's say, customized stable coins for different use cases issued by different issuing companies or entities, but with some certain same components or some let's say same layer of legal compliance. Let me put it in other words. You have the possibility to have five different customized stable coins, which are at the beginning like empty glass jars, and in every glass jar you have the same compliance cookie as essential part, and everything else you can customize and change however you like. But this basic layer is as per regulatory requirements, and this stays the same. I think that all the players will be utilizing um, public open blockchain infrastructure, as is the case with USDT, Tether, and Circle. Um, for example, maybe Ethereum, instead of building out new or adapting any or making an adaptation to their own rails. It is much cheaper, it is faster, you don't have any I don't know, capital expenditure or operational expenditure when you need to use it, and you have it instantly at your disposal for worldwide payments. So the underlying infrastructure will largely be the same, allowing to tap into existing interoperability of that said infrastructure, which extends your reach to tap into different ecosystems, different user bases, different business environments, while you at the same time continue to adhere to different regulatory compliance requirements. For example, MiCA or US Genius Act, as we've seen it approved yesterday. So liquidity swaps and access restrictions between some stable coins in the same denomination may get, let's say, certain issues in the early stages, meaning Apple USD stable coin is part of their closed or gated community, and you can use it only inside Apple ecosystem, and you cannot swap your Apple USD stablecoins as easy or as liquid for example, USDT. So I think in the beginning this might be some of first, let's say, obstacles or challenges. Speaking of branded stablecoins, they can have built-in loyalty schemes or programs, which can come, don't have to, but which can come with DeFi functionality, as we see it in the crypto native versions of stablecoins. But this may be dependent on, I don't know, compliance overhead, or just, as I mentioned with Apple, gated communities preferences. Um, I think that all those branded stable coins that I see coming will actually enable seamless platform integration with, for example, other neobanks, other fintechs, other traditional banks, just for the sake of ease of payments and extending the reach of own USD version of stable coins. I can imagine also the same for many commercial banks, privately held banks that will have own version of USD stable coins, just to bring some extra perks or to unlock, let's say, certain functionalities for their user base. Hey, if you use our stable coin, you will have free account, you will have, I don't know, higher yields or lower lending costs because you are part of our ecosystem. So I see that coming. I also can imagine that commercial banks may have USD stablecoin versions that are only meant for the usage in international trade, such as, for example, a letter of credit issuance and stuff like that, which will be not accessible or available to retail clients.
Mhm. What's the macro signal you are paying the most attention to this quarter?
Um, I would say for the second half of this year, I have to be aware of what's going on U.S. bond market, tariffs policy development with Trump statements and Trump flip-flopping the entire time. How this affects potential for U.S. Fed rate cuts, based on inflation and unemployment data, and this also has to do with tariffs development. Also, global liquidity, the development around kinetic wars that we have in the Middle East, in Russia, maybe potentially China, Taiwan. I mean, all this has impact on the risk on sentiment and willingness of investors to um, invest in risky assets, and crypto is a risky asset. Um, and this is, of course, by extension, very important for broader crypto landscape and crypto markets in general. As soon as there is again massive market turmoil, as we've seen end of March or the start of April this year, everything is going to get affected. Some assets to a lesser extent, and some other assets to very large extent.
Has your investment shifted at all in response to what's happening in the current quarter?
Um, yes, it has. I mean, frankly, the model shifted last year from mainly crypto native to now include more of macro aware investing. With the regulatory support in full swing right now, I focus even more on projects that have high tech quality, utility, sustainable business models, as mentioned a couple of times. Protocols that combine, um, let's say, technical innovation with sound business fundamentals, and ideally also have some relevant regulatory alignment are on top of my list. Um, I remain aware of macro and political signals, and I incorporate that into my allocation decisions. It is a must-have in the meantime. Like talking about 2, 3 years ago, I really did not care about any of those macroeconomic data points that are relevant mainly for U.S. economy, like non-farm payrolls or general unemployment rates, continuous claims, CPI, PPI, and stuff like that. But now, due to increased regulatory backing and institutional involvement from U.S. Let's say economy in general, the crypto markets are heavily intertwined with the U.S. economy developments, U.S. economy strength, U.S. Economy weakness. Everything is now more correlated or sensible to such developments. So regulatory clarity and growing institutional adoptions gives us, I would say, a new investment environment. And I'd say in this new investment environment, the rewards are skewed to more in favor of fundamentals over short-lived momentum. So I mean, Trump coin might disagree, but I think you get the picture. Fundamentals will get rewarded over a longer period of time, as opposed to short-lived, shiny new things and flavor of the month.
Mhm. If a founder walked in today with a bold idea,
Mm.
what would make you want to hear more?
If that founder and business idea have sound business fundamentals, at least at the first glance, I would like to hear more. If there is some regulatory positioning, depending on the relevance for the said project, I would like to hear more. I would also like to maybe explore how the project can function without having own token. A lot of projects are eager to launch their token and have token allocations, and but essentially they can function without having own token. So I would really like to explore that, maybe in the second, third step. So is is if there really needs to be a token, what is it for? For whom is it? What kind of functionality does get plugged in or programmed in into this token? So, what is the value accrual mechanism for said token or for the project? Do you have, for example, as mentioned, fee distribution or any revenue sharing? Is it deflationary? Do I have, burning schedules? Why would I want to hold the token in the first place? I'm the user. At the end of the day, I hold your tokens for your great project idea. What's in it for me? What do I get for holding your token? Those are some, I would say maybe fundamental questions that I would like to get good answers to in order to be able to, take a deep dive into project and maybe do technical due diligence in the next step, and then I would also like to understand the team composition, who are the people, how they work, what have they done already, what's the, let's say, chemistry in the team, because at the end of the day I've also had quite a few examples. Everything works perfectly, project idea is sound, everything works like a charm, we are all happy. You have team members fighting with each other and getting greedy, or you have some, let's say, um, yeah, lack of love. The vibe is not vibing in the team anymore, and the project collapses, because without proper team you do not have a project. There will no it project will not survive. So team is very essential component, and looking into how team works, and getting to know each member individually gives me also an impression how the team might function or is likely to function when the turbulent times come, when the storm comes, and when they have to stick together and work together and endure. Those are some of the critical questions. Maybe one of my favorite questions when it comes to token economics is to clarify what breaks your tokenomics model. What makes it not work anymore properly? What are its weak points? Because knowing this stuff in advance can save you a lot of time, a lot of capital, a lot of energy, not only for you as an investor, but also for the team, because it gives you as a team clarification. Hey, we did not really think about that or didn't think it through. Wow, thanks for pointing that out. Let's go back to the drawing board.
This was a deep dive into how Bitcoin is reshaping capital markets, how stablecoins are shifting global influence, and why disciplined, informed investing in Web3 should be a non negotiable priority. Igor laid out a view that's sharp and incredibly grounded in macro, on chain, and venture logic. Thank you very much.
Thank you, Nasib, for having me. Happy to come once again.
What's the best place for listeners to follow your thinking or get in touch?
Um, for starters, on LinkedIn, my profile is unlocked. Anybody can DM me and just reach out to me. There is in the upcoming weeks and months a new channel for content, podcast, and video, and written format for my analysis, which will be made available also to non investors in our company. So anybody who is interested in this matter, in this topic, will be able to benefit from it.
I will include the links everywhere to both your profile and Venionaire Capital's profiles as well. And to everyone listening or watching, if this episode gave you a clear sense of where crypto capital is going next, make sure to follow these guys. They are doing something really, really interesting and something really important. Also, make sure to like, subscribe, or follow me and send this episode to someone curious.